Dear viewers, Apple recently released a video in which the CEO, Mr. Tim Cook, playing himself in the ad, has a tense exchange with Octavia Spencer, starring as Mother Nature in the ad. She asks some tough questions, demanding accountability about Apple's carbon footprint, plastic waste, and recycling. A nervous Mr. Tim is defending Apple's initiatives towards a sustainability drive and finally makes a point with a new product, Apple's Watch, which is 100% carbon neutral. He commits that by 2030, all Apple devices will have a net zero impact. By the end of the ad, it seems that he has pacified Mother Nature and has won his customers too. In 2020, BlackRock CEO Larry Fink put the world's largest money manager behind the cause of purpose driven investing. Ever since, sustainability is a new buzzword. Global MNCs are getting more vocal and serious about sustainability targets, and this time with hard deadlines. Apple is not alone. Colgate and HUL have shared a target to use 100% reusable, recyclable, or compostable plastic packaging by 2025. P&G is catching up with a similar aim by 2030. Now, I don't believe in following narratives blindly, be it ESG or renewable energy. It is always about a hunt for solid company with strong balance sheet. But there is one small cap company that seems all set to benefit from the race to sustainability by global MNCs and looks good on fundamentals too. EPL Limited, formerly known as SL Propec, belongs to the category of small caps. But its credentials are quite big. It is the world's largest specialty packaging company. The company has backward integrated facilities that make laminates to tubes. Its key raw materials are polymers like HDPE, LLDPE, and aluminum foil. The plastic tubes it makes contain the products of blue chips in FMCG, pharma, beauty, cosmetics, and food industry. With over 8 billion volume base, it commands 20% global market share in this segment worldwide. Within oral packaging, that is the products like toothpaste tubes, it commands 35% market share globally. Oral category accounts for 52% of its revenue. The share of non-oral tubes is 48%. The segment combines beauty, cosmetics, pharma, food, and others. EPL has 10% market share in personal care and 8% market share in home, food, and industrial segments. Now, these are impressive market shares. But what next? Already a market leader, how can this company pull off a double-digit growth rate that it aspires for when the FMCG industry itself is growing around 5%? It will indeed require the company to take market share away from the competition and get a higher wallet share with its customers. And that is where it is betting big with its sustainable packaging offerings. EPL has been working on its molds and machinery to make them fit to produce recyclable tubes. The management has said that 85% of companies' machines are ready to make recyclable tubes. The share of recyclable tubes was 10% in FY23, it is nearing 20% in FY24, and by FY26, the share is expected to hit 60%. What's more, the company boasts sustainability ratings from EcoVadis Gold that places it amongst the top 3 plastic making companies in the world. If the MNCs have made up their mind to have 100% sustainable packaging products, sooner or later the supply ecosystem will have to follow. The company wants to beat other players on this aspect by being ahead of the curve. Well, the management sees sustainability as an aspect that will help it improve its right to win more business, market share, wallet share, and add clients. And it does not intend to charge higher just for offering sustainability. That's one growth driver. Another is a greenfield facility in Brazil, which is a virgin market. So far, the company is supplying to one major customer, but it is in talks with 10 others and expects to add more. So, what does it mean for growth? The company expects 8 to 9% kind of growth in the oral segment, where it already has 35% market share. In the non-oral or personal care segment, it expects a much better growth as this segment is relatively underpenetrated with just 10% market share. Now, do note that the non-oral category globally is a bigger opportunity to exploit in absolute terms. It's a market of 25 billion tubes as compared to 17 billion tubes in the oral category. In fact, its revenue share from non-oral category over the last few years has been consistently increasing, and the trend is likely to continue. The company covers a wide range of markets as shown in the slide here. The growth prospects and margins are better in AMESA, that is Africa, Middle East and Asia, and EAP or East Asia Pacific market, as inflation and slowdown concerns prevail in America and European economies. But overall, the management expects a double-digit growth in the top line and 20% margins in the business. The company expects higher insourcing of products such as cap closures to help in improving margins and efficiencies. The capex required is likely to be in line with the depreciation expense for every year. The challenges could be slowdown in the western regions, currency fluctuations, inflationary pressures that have led to margin contraction in the last 2 to 3 years but are easing now. Almost 50% of the business is on contract basis that uses formula-based pricing, and there is a time lag of around 3 months. Coming to the management, in 2019, Blackstone took over the promoter stake in the company at a price of around Rs 136 per share. It further acquired 26% stake in the company, taking its share to 75% through open offer to public shareholders. In 2020, it brought its stake down to 52% through market sale at Rs 256, and the stock is trading at around Rs 200 as I record this. As against a revenue of 37 billion in FY23, the management is targeting up to Rs 46 billion in FY25 and up to Rs 58 billion in FY27, with a margin of up to 21% to 22%. For the trailing 12 months, the revenue growth has been at 8% and EBITDA margins have improved from 15.4 to 16.8%. The return on equity is at 12.5%. If the margin and growth are in line with the management expectations, there could be a meaningful improvement. In the latest quarter, the ROCE is at 16.5% and the debt to equity stands at 0.4 times. The dividend yield on the stock is 2.2% with a payout ratio of 60%. The stock is trading at a PE of 25 times and a PEG or price earnings to growth ratio of 0.7 times. Do note that this is not a stock recommendation. You must assess the risk and valuations before you take that call. But all in all, EPL is one candidate that should be on your watch list if you are looking at sustainability theme. With this, I've come to the end of the video. Hope you found it worth your time. Press the like button if you did and do let me know your views in the feedback section. Thank you for watching. Goodbye.